Folks, I don't know if you're even going to believe this, but the non-QM space is loosening up. How do I know that? I have seen non-QM lenders offer more leverage than I've seen in the last 6 months. I think this means bigger things. This is clearly a pivot or a change. And I'm going to ask one of the guys in the business, what the heck is going on? Am I wrong? Because maybe my tea leaves are wrong. But Dustin, what the heck is going on in non-QM? I've seen some higher leverage than I've seen in the last 6 months. What's going on?
Yeah, no, it's something that John and I have been on a fair amount of board meeting calls with investors, calls with funds on Wall Street, and their appetite, surprisingly, given where the market's at, over the last 6 months, rates have went up, or last year, leverage has went down, right? Yep. But now, next week, we'll roll it out when it's official. We're going to have like a 85% cash out DSCR type loan, where I don't need to tell most people watching this show, getting cash out when it's a first position loan over 75 right now, or even over 80, that doesn't exist. And it's actually only existed for maybe 3 or 4 months in end of 2021, maybe the first month of 2022. So the reason we're seeing that is, look, from what we're hearing from our funds on Wall Street is that these are well-performing loans from their point of view, right? Payments are getting made because of the fact that on rental loans, they're viewing it as they're pretty stringent, right? They're going to make sure that it can be rented out, but those payments are much more reliable, in their opinion, than obviously doing a primary residence where somebody's job is on the line, or somebody's
Interesting. Wow. So again, Wall Street's job is to put money to work. Yep. And I did not connect that dot, but that makes perfect sense. What they're basically saying is we're going into a slowing economy. We are going to see more job loss. So I was right. We saw the first uptick in weekly jobless claims in 9 weeks today, right? 212 versus an expectation of 195, 190 last week. Not that I look at these numbers all the time, but there you go. But yeah, it's really interesting to see Wall Street go, you know what? We want to move some of our ammo at the rental market because it's a more dependable cash flow. And again, that wasn't always the case. 6 or 9 months ago, they went owner-occ. They went away from investment property. So now they're coming back. And 85% DSCR cash out. I think if I would have had to guess, it would have been 70%. It's crazy.
Yeah, I mean, right now, best rate, technically, if you're taking cash out, it's going to be 70. We can get up to 75. 80 is pretty ugly in terms of the rate. Now, 85 is going to be ugly. Don't get me wrong. The rate's going to be much higher.
As it should be ugly. But the fact you can.
Exactly. The fact that you can is just, I think it's more important, not just, it's an 85% cash out. It's this industry is actually maybe seeing a little bit of a pivot in terms of investor appetite. And maybe we'll start seeing, obviously, some different programs. Who knows? A different
type key.
Of right?
That's what I am seeing in this, right? Because again, I keep telling people, there's a real estate market, but folks, you're not paying attention. There's a lending market. This thing is real estate for the most part is a lending, business, right? It's what makes the system go. And by having this non-QM pivot, clearly change, clearly go higher leverage, I think it's a sign that they see the terminal rate is closer than it was. They now have confidence they're not going to be rug pulled with the terminal rate at 9% or something. And they're looking at risk to owner-occ being higher than it was the last couple of years. So they want to, because again, they got a pile of money, they're going to pivot. And it clearly looks like they're coming to investors, and that's the key. This is just the beginning. You will see a lot more creative programs come, I think.
No, and I agree. Like you said, it was 6-9 months ago they made the pivot away from investor loans or non-owner occupied loans, and kind of focused on the owner occ. Now, obviously, there's another player involved that we're not talking about, but everybody knows, your Fannie, Freddie, agency type loans. They're still going to stick with owner occ right now because they know that that's their job, right? To have home ownership as your own occupied home ownership. But the fact that we already touched on it, we're seeing Wall Street and funds actually like this space now more, I think is an exciting thing for things to come that we'll obviously be touching
Well,
on in the next couple months.
yeah, well, the other thing that people may not be paying attention to unless you're in the business like you and I are, is Fannie and Freddie are becoming anti-investor,
So
right?
bad.
They're lowering cost on owner ox, they're raising cost on investor, they're doing everything they can to say owner good, investor bad in fees and costs and in all of these things. And I think that's probably something else that non-QM space is seeing. It's like, okay, well, if Fannie, Freddie, and the agencies are saying investor bad, maybe there's some low-hanging fruit, some really good opportunities to go after. What do you think of that?
I mean, it's 100% accurate because just looking at two of the biggest, let's say, changes that agency loans did in the last month and a half. One, the FHA reducing their private mortgage insurance premium almost
Yeah.
in half, right?
Yep. Yep.
That helped owner ox. What did they do for non-owner occupied? Made it more expensive. So they made the gap even wider over just the
Yep.
last month and a half, clearly pointing at what they're trying to do versus, like you said, the non-QM side and kind of the more private DSCR creative financing side is seeing that, taking the low-hanging fruit and being like, let's gain some more market share while we can.
Yeah. And I think what we're seeing in the kind of agency, Fannie Freddie stuff is a clear sign of what's to come. This is just the beginning. I think what we're going to have in a market where that is bare for first time home buyers is even more. I think we're going to have down payment assistance programs of another ilk. We're going to have waiving of fees, probably even offer some kind of discounted rates, but that's going to come at a cost. And the cost is going to be banged on new investors. And thus, I think non-QM is like, okay, let's get ready. Let's go over there. If Fannie Freddie's not going to treat them right, we'll go over here. We'll be a little bit higher on rates, but we'll be less of a hassle and try to gain market share. I think that's a great business move, frankly.
No, and I agree. And what's funny too is like, we've watched the spread between non-QM and conventional rates for investor loans. Me and John and everybody in the industry on our side watches it daily. Right now, like if we're talking par rate with no points on like a 70% purchase, I can get cheaper rates on our DSCR or a private fund than I can if I took somebody to full doc
I want
convention.
people say that again because people do not understand what you just said, and it's critical.
Yeah. So if there's two ways to basically qualify. You either go Fannie, conventional, 2 years of tax returns, W-2s, all that, or you
Yeah,
can go
and again,
non.
when people in that environment, they put you in a system, they push a button, and it says approve eligible. That's full doc, right?
Yep, that's full doc.
Okay, so that's one, and you can get a better rate than that. I want people to hear that because they need to be reaching out to Convoy if they're an investor, and then you can help them understand what may or may not be right for them.
Now there is one caveat.
Please.
Conventional loans, you can actually buy it down further. So if you want to pay points,
Oh, okay,
you
okay.
can
So
rate
you
lower.
did par. You were doing par. Okay.
Exactly. So I've been pricing for the last week, just kind of par pricing, and every morning we have a meeting seeing where we're landing. But par pricing on just like somebody with a 740 FICO purchase, 2 unit, 70% LTV, I would actually steer them into the non-QM side because it's actually cheaper than going full doc right now. That might change next week.
It could.
Right
Yeah, I mean, it
now,
could change tomorrow. But again,
yeah.
what I see coming, and again, people can follow this. I look at it all the time, been doing it for 20 some years. Fannie and Freddie are going to focus on owner occ as they should. The first time home buyer has never had it so hard. There's no inventory. Affordability is at rock level. They should look to help them. They're going to take that money or pay for it by punishing the investors. Hence, sometimes going non-QM. You've got to work with a professional like Convoy Home Loans. How should they reach out to you, see what's right for them?
Yeah, you can just head to our website, convoyhomeloans.com, and just mention that you came from ORAT. That way, myself or John can be the one to help you guys out.
Awesome, Dustin. Thank you so much. Thank you for all you do.